And Julia, certainly we saw a reaction from the Australian dollar, and it's managed to hold a lot of those gains, but not the Australian share market. As we saw there, finishing really flat. Why did we lose that 0.5%?
We did see the market peaking up after those Capex numbers, and they were better than expected, coming in at 3.6% growth for the third quarter, and that compares to market expectations, which actually expected a step back, so a minus 1.2% result. In particular, we were watching mining because this is where the big difference was to have occurred. Last quarter, in the second quarter, we did see a rise of 6.8%, and in the third quarter, we actually still saw strong growth, although not as strong as the second quarter, coming in at growth of 5.6%. Even manufacturing, which was down 7.8% in the second quarter, managed to see growth in the third quarter with a rise of 1.5%. So altogether, these numbers were very positive. And if we have a look at the intraday graph for the ASX 200, this is what it looks like. You can see after those Capex numbers, we did see the Australian market hitting the peak of the session before just wandering down the rest of the day. And we did close on the lows of the day. All up, part of it was the low volumes. We only saw $3.7 billion worth of stock being traded. And of course, going into the US session tonight, we have a holiday due to Thanksgiving and also just a half day of trade in the US on Friday because of that Thanksgiving holiday as well. So all up, pretty quiet down the session. Unfortunately, that just meant we gave back those gains. Having said that, I think one bright spot was the financial space. We've seen the 5th consecutive day of gains for the banks. But on the flip side, you know, the energy sector was looking pretty weak. We saw oil prices down by 1.4% overnight, consumer staples losing ground as well as the property space. So all up, not looking too good for the Australian market.
What about Macmillan Shakespeare? That certainly was a bright spot for the local market today. Julia, up about 10%. Is it back to business as usual for this company, which was, if anything, the election play?
It is back to business as usual, and those comments saw the shares skyrocketing higher today, by the close up by 9.3%. Now, if we have a look at Macmillan Shakespeare, it's involved in salary packaging and novated leases, but really we haven't seen the share price returning back to the pre-July levels. And of course, July was when the Labor government at the time mentioned changes around the fringe benefits tax, and it saw the shares plummeting by 42% in one session on the 25th of July. Since then, the shares have slowly recovered, and we've actually seen the shares rising 35% since the 25th of July. But we're still not back to that pre-announcement level. Pre-announcement, the shares were trading around that $18 mark. Today, we saw them trading around that $13 mark. And it looks like the market's still building in the risk, the regulatory risk from any changes in the fringe benefits tax. And that's because Macmillan Shakespeare really is a company that is dependent on the tax concessions related to the fringe benefits tax. So while we did see a sharp jump today, and great to hear that earnings are back to normal, still I think the market's pricing in a bit of regulatory risk given what we've been through over the past 6 months.
What about SEEK? That was another bright spot today. Shares gaining about 5%. We saw a bit of an upgrade to the domestic operations, but it's also looking to spin off its education business. Julia, tell us about that.
I think the spin-off is a good idea. We've seen in the past that spin-offs have created shareholder value for companies on the ASX. So the fact that it's mentioned that it is looking to spin off its educational arm has been fantastic news for shareholders today. We have seen the shares jumping by about 6%, and that means the shares have been trading today at the highest level that we've ever seen in the history of SEEK. And if we have a look at some of the commentary coming out today, also quite positive, saying that they've been seeing flat to gentle rise in job ad growth, and domestically they do expect revenue as well as EBITDA to be higher as well. They've reaffirmed guidance, and the fact that they are looking at spinning off in 2014 this educational business very much under the spotlight. Now they are looking at spinning off IDP Education. SEEK actually owns a 50% stake in this business, and around about 38 universities own the rest of this. But part of this business is the IELTS, which is the International English Testing Centre, which will be part of the spin-off and is part of this business. So if we have a look at valuations, it could be valued at about $300 million. The EBITDA forecast for the current financial year is about $46 million. So very much that potential IPO in the spotlight. it should be good news for shareholders, and the shares rallying on the back of that.
Let's talk about Forge Group. We've seen some seriously bad hits for the mining services plays this year, but nothing intraday like this one. The stock closing down about 83%, Julia. This on the back of, a profit downgrade, really. Two of the assets are going to be worth a whole lot less than previously thought. Now, though, if you had have bought in at the worst case scenario, down about 90% today, you probably could have doubled your money.
The shares were trading below 40 cents when it initially opened at 10:20 a.m. But throughout the day, we've seen a bit of volatility, and the shares closing up at 68.5 cents. Now, if we have a look at Forge Group, it's come out of a 24-day trading halt, so it's been a while since it's traded on the market. There's two parts to the announcement today. One is the update that we've received around its business and essentially the profit downgrade that we've seen. And secondly is the debt deal with ANZ, which will ultimately mean a dilution of shares for shareholders. Starting off with the update, we know that it's been having trouble over those two power stations, and they did announce write-downs of $127 million. Additionally, related to those two power stations, they are going to need $45 million worth of cash to complete those projects. So that's one part of the announcement today. And that's going to lead to an EBITDA loss of between about $85 to $90 million for the company. The company, though, coming out to say, remember that they still do have an order book of $1.8 billion, and about $900 million of that will be executed in the current financial year. Now, the other part of the announcement is around the debt deal with ANZ. Now, the debt deal with ANZ means that the debt with ANZ will rise from $11 million up to $60 million. So that's a rise of more than 5 times the amount of debt that they had previously. Not only that, that will allow ANZ to have warrants over the shares, which equates to around about 13% of the company once it is converted. So altogether, for shareholders, a lot to absorb. First of all, we've seen a profit downgrade related to write-downs, and secondly, that debt deal. But Forge Group's still probably looking for an equity injection, and that's going to remain a cloud over the shares and over trading.